Is one of Michael Burry's favorite stocks, JD, a good stock to buy now? Welcome to Global Value. In today's video, we're performing a fundamental analysis of JD using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what JD.com is worth in today's stock market. I'll share that at the end of the video. Plus, along the way, we'll look at 2 special bonuses that could be the deciding safety factors when adding JD stock to your portfolio. Right now, JD trades for $35.34 per share. In its last day of trading alone, it's up 2.41%. Since January of 2024, JD stock is up 27%, which beats the market where the S&P 500 is up 20% at the same time. But in the last 5 years, JD's underperformed the market. They've only returned 8%, even though they were beating the market up until 2023. And when we go back to when JD was listed as a public business a decade ago, they've returned 53% over this time. They had great performance for most of their history, but in the last year and a half, things have gone downhill in their stock price. But right now, that's not all for shareholders. Today, JD pays a 2.1% dividend yield, which is added to the gains in their stock. JD is currently trading $12 below their 52-week high, and they're trading $15 above their 52-week lows. Altogether, they're one of the leading Chinese e-commerce businesses and have a $50 billion market cap. Getting started with metric number 1, we want their average returns on capital to be greater than 14%. Returns on capital are like your form when you're in the gym lifting weights. You want great form, that way you can grow more by adding more weight over time. Returns on capital function the same, and a normal business earns around 7% average returns. JD, unfortunately, has been below that mark in 4 of the last 5 years. But there's a big trend to see here in their numbers. Their returns on capital have steadily improved from 2021 onward. In this time, they've gone from a measly 1% up to 8% at the end of 2023. And in JD's last 12 months, they're actually at 9.3% returns on capital. That uptrend is something great to see, and it's something to continue to watch, as this might be a great inflection point for the business. Still though, their average returns in the last 5 years only come out to 4.5%. That's just about half of normal returns and well below the benchmark we wanted. This is an X on our first metric, and it's not altogether uncommon with Chinese businesses. Now, what does JD really do? JD.com is a leading e-commerce platform in China, with their gross merchandise volume being similar to Pinduoduo, but they're still lower than Alibaba. JD offers a wide selection of authentic products with speedy and reliable delivery. Think of it like Amazon. The company has built its own nationwide fulfillment infrastructure and last-mile delivery service staffed by its own employees. This supports both its online direct sales, its online marketplace, and its omni-channel businesses. Next, we want growth in their sales, earnings, and cash flows. When you've got a good thing going on, you want more of it, right? For JD, they've grown their sales by 92% in the last 5 years alone. Things really took off for the business following 2020. At the same time, their earnings have doubled and their free cash flows have almost doubled as well. The business is more profitable today than it was 5 years ago, and it's earning a lot more too. This means it's our first check of the day coming in on metric number 2. One thing to note is that the company's sales have been pretty much flat for the last 3 years, though that may be a factor of the pull forward in demand due to COVID and weakened consumer spending in the Chinese economy. Now, who else besides Michael Burry owns the company? JD is in the portfolios of 5 super investors, and Burry's position is by far the largest, with this making up 24% of his holdings. Burry's betting big on China, with it making up 3 of his top 4 stocks. In the latest quarter, JD was the company Burry added to the most, doubling his position toward the end of 2024. Several other famous investors, including David Tepper, Howard Marks, and Berkshire Hathaway board member Chris Davis, also are invested in the company. Next, we want to look at JD from the view of an individual shareholder. Here we're looking for earnings per share growth. Looking at the chart, in this time their earnings have bounced around somewhat, though generally things have gotten better in the last couple of years. 2023 was above 2019, and 2024 is even higher, coming in at $3.20 per share. JD's also repurchased 4.6% of their shares outstanding. That's even better, as their earnings are up and their stock has been depressed over this time. It's another check, and JD's starting to build momentum. Metric 4 is similar but even more important. We want JD's cash flows per share to have grown in the last 5 years as well. This one's different from their earnings in that JD has posted positive cash flows per share every year. That even came during 2021 when their earnings were negative. Like their earnings though, JD's continue to grow these over time, with them up nearly double from where they were at in 2019. This is another check as their cash flows per share are up. And so far through 4 metrics, we have 3 checks and only 1 X for JD. Now before we look at the company's balance sheet, it's time for our first bonus. Right now JD pays an above average dividend yield of 2.1% for a tech company. But are their dividends safe and can they keep growing these into the future? That's what we're trying to figure out with our first safety bonus, where we want their dividends to be covered by their cash flows. JD started paying regular dividends in 2022, and so far that's been the case. They've easily been supported by both their earnings and their cash flows over this time. In fact, JD just has a 23% dividend payout ratio, and they grew their dividends by 23% last year alone. That's huge growth even though this is a small base. Overall, with their share buybacks, they have a decent 3.2% shareholder yield. Building on this momentum, in our fifth metric, we want their balance sheet to be in healthy shape. Here we want their net debt to be covered by the sum of their free cash flows, and JD's actually in great shape. They've had a net cash position in all 5 of these years and positive cash flows to boot. They've reduced their cash cushion in the last couple of years as they've started buying back more shares. Today, this sits at $14.6 billion, and in the last 5 years, JD's brought in $22.5 billion of free cash flow. Not only do they have a lot of cash sitting on their balance sheet, they bring in a ton of cash flow, and this company looks like it's in strong financial shape. This is another solid check on metric number 5. Long term, things are looking good, but let's look at the short term too before we figure out what JD's worth. Warren Buffett's teacher and the father of value investing, Ben Graham, wanted to see a current ratio greater than 1.5 times. This is a key measure of short-term liquidity for how a company's current assets can be used to pay their current liabilities. In the case of JD, this has been below that 1.5 times mark in each of the last 5 years. Though this is special for retailers and e-commerce businesses who can have some different terms here. Having a lower current ratio in their case could actually signal business strength, especially as they're able to get better deals with vendors. We can't exactly give them a check mark here, but this may not be as bad as it seems. Now, what is JD worth? The big metric of them all, metric number 6, is our first valuation. We want JD's average free cash flows divided by their enterprise value to give us a yield that's greater than 5%. This can build in some margin of safety compared to the 10-year treasury. Today, JD has a $45 billion enterprise value. In the last 5 years, we learned they brought in $22.5 billion of free cash flow. This means that in an average year over this time, they're bringing in $4.5 billion of cash flow. That's exactly a 10% average 5-year free cash flow yield. In the last 3 years, they bring in $5.2 billion in an average year and have an 11.5% yield. And in their last 12 months, JD brought in $4.6 billion of free cash flow, and they have a current free cash flow yield of 10.2%. All 3 of these yields are double that of the benchmark we wanted and more than double the 10-year treasury. This is a huge check on metric number 6 for JD. But don't just run out and go buy the business. Even though this looks cheap here, we still have 2 more valuations to look at before we figure out what the company's worth at the end of the video, so stay tuned. Next, we're using a DCF model to give JD credit for its growth. We'll start with an average of their cash flows and use historical assumptions to grow them into the future. Let's start by assuming that they'll grow their average free cash flows at 5.5% annually for the next decade. Then in the following decade, let's assume these decline and only grow at 4% annually. After that, we'll add in their tangible book value to estimate their net worth. If we want a market-beating 15% rate of return, which is the same return that Warren Buffett looks for, then using these assumptions, it looks like a fair DCF valuation for JD may be as high as $49 per share. Please keep in mind in the last handful of years, this hasn't been that predictable of a business. Then our third valuation technique uses their GF value, which today comes in at $42 per share. That's up 15.5% from their current stock price. Now, Warren Buffett and Michael Burry like numbers, but it's really the qualities of a business that are their main draw. Next, we'll learn what these are for JD through a long and a short thesis. Why don't we start with a long thesis first? Number 1, JD.com's new free return, exchange, and shipping policies substantially increased its user base. They've also increased purchase frequency and average order volume, which has led to better than expected profit for the firm. Number 2, JD can increase the number of its merchants and their competitively priced products. This means they're similar to the scale of Taobao, 1688, and Pinduoduo without sacrificing margins. And number 3, JD has adopted generative AI in its platform to help customers buy products that meet their specific demands better than compared with its peers. This has led to market share gains. But things aren't all positives. Let's look at a short thesis as well. Number 1, many customers associate the JD.com brand with a substantially poorer quality of products and services and insufficiently competitive prices. This has come as JD has pushed its third-party platform, which has led to lower than expected sales. If we think back to that US Amazon analogy, the majority of Amazon's retail sales come from third party. Next, number 2, JD's profitability has suffered due to higher employee compensation, lower take rate, and heavy investments in the business. This includes the introduction of their lower free shipping threshold. And number 3, JD.com has expanded into value-destroying domains in which it lacks competitive advantages. This has resulted in recent lackluster earnings growth. Now, why don't we put everything together for JD? In our fundamental review, we learned that JD.com goes 5 for 6 on the Select 6 analysis. The company is only off when it comes to their average returns on capital, which have been improving in the last 3 years. At the same time, though, their sales, earnings, and cash flows are up, and their shares outstanding are down amid repurchases at lower stock prices. The company also has a huge cash cushion of nearly $15 billion on their balance sheet, and they're trading at very attractive yields compared to the 10-year Treasury today. JD is also returning some of their capital directly to shareholders through a 2.1% dividend yield. Remember, this analysis isn't financial advice, and it's not a buy or sell recommendation of any security. There are risks involved with buying securities, especially ones whose main businesses are overseas. When we combine all the factors of our analysis, today it looks like a fair value for JD comes in around $47.96 per share. Keep in mind, fair values a range on either side of that, but that's up $14 from their current stock price and close to their street target price. JD.com looks undervalued. If you enjoyed today's video and you want to support the channel, click the first link in the description, which will take you to Interactive Brokers' Global Values affiliate. Research their investment options and you can support the channel absolutely for free.